Welcome back. Now, the last time South Africa got an interest rate cut was in July, 25 basis points, while many hoped that with inflation still comfortably falling within the 3 to 6% target range, that we would get another cut last week. But the MPC held steady with the repo rate stuck at 7%. In the meantime, the jury is still out on the preferred lowering of the inflation target to 3%. But Deputy Finance Minister David Masondo recently admitted that the current inflation target is too broad. Daniel King, MD of Merchant West Investments, joins us with his assessment of the interest rate trajectory. Thank you so much for your time, Daniel. Now, on that point of standing pat, I mean, you look at the last inflation print that we got stands at 3.3%. It's a price to the downside, and it's at the lower end of the target range that we currently have in place. The rand is strong, so all of these factors seem to pave a way for the SARB to cut rates last week, but it stood pat. Did this move signal a commitment to creating conditions where inflation moves to and sustainably stays at the 3% target that the SARB desires?
Exactly. I think that was the intention. Although we recognize that the vote within the MPC was split, so it wasn't a unanimous decision to hold the repo rate. I think broadly speaking, the announcement by the governor and rather than the Minister of Finance of this new inflation target, and then the decision itself does give us some reason to believe that the current Monetary Policy Committee is very serious about that new target. I think, it did surprise me that they held the repo rate where it is in the last meeting. But I think that tells you something about, what they look at. One variable being inflation expectations. And typically the Monetary Policy Committee places quite a high weight on various measures of inflation expectations in the economy, medium-term inflation expectations, and those are still, they've been coming down since the governor made his announcement, but they're still hovering around closer to the 4% level than 3% level. And between the Monetary Policy Committee's own forecast of inflation, heading towards 3%, and their decision, it tells you they're taking that very, very seriously. They want ideally to see expectations in the marketplace and survey-based inflation expectations to move towards 3%. I think before we get or could plausibly enter into a steeper, more meaningful cutting cycle, which hopefully allows interest rates to settle at a lower structural level than what we've been used to in the past.
All right. I mean, just in terms of, you mentioned that the SARB takes this inflation target change very, very seriously. I mean, is this credible, though, for the economic conditions of South Africa? And what monetary policy approach does it create?
Yes, I think clearly it's going to result in a fairly tight monetary policy stance in the interim period. Over which inflation expectations are being managed. Is it credible? I think in terms of market credibility, there is a sense that there is some credibility to the target. If you look at the behavior of bond yields in South Africa and the inflation risk premia that are embedded within those bond yields, they have been coming down since the governor made his announcement. So there is a sense that there is market credibility. I'm not sure yet if there is policy credibility. I think that the precedent that was set historically, and this is going back to 2000, when the current inflation targeting regime was kind of introduced into the South African economy. It was the Minister of Finance that would make the announcement of the target following a consultation with the Governor of the Reserve Bank. That happened in 2000. They made a small adjustment again in the medium-term budget policy review a couple of years later, and reversed it again some years after that. And all of that was announced by the Minister of Finance following consultation with the Reserve Bank governor. And what has happened in this latest change is that the governor has announced the change in the target. And so there is some uncertainty as to whether that is consistent with the precedent that was set. In my layman's reading of the governing documents of the Reserve Bank, being the Constitution itself and the SARB Act going back to 1989 and all of its subsequent amendments, there's nothing particularly prescriptive around the inflation target or how it must be set. But there is some level of engagement that is required between the Reserve Bank Governor and the Minister of Finance. So I think the quicker that the two institutions, being the National Treasury, Ministry of Finance, and the Reserve Bank, can come to a consensus, the better it will be for policy uncertainty. And the quicker the inflation expectations can be anchored at a level at which everyone is comfortable with. But yes, in the interim period, what it means is certainly higher short-term interest rates as they move towards that target, presuming that the target is maintained and agreed to between both of the key institutions.
Considering the impact then of, monetary policy, in a period in which they are trying to embed inflation at around 3%, what would that change then mean for the South African markets? Because investors want to know, what would this mean for them?
Yes. So I think there's a mixed effect, and it's quite a delicate balancing act. I think that in the short term, clearly the bond market has liked it. So bond yields are down, and that's, that is reflected in a capital gain in the bond market. But and similarly, I guess the currency, in a global context in which most central banks are cutting interest rates, and ours is, static at a relatively high level. That would tend to be fairly supportive of the rand. So it doesn't do any favors to our global competitiveness. So it's fairly, all else equal, it's pretty negative for exporting industries. But it can provide a boost to consumption, that strengthening of the rand relative to some of our key trade partners. That being said, as I said, it's a balancing act, and I think that to the extent that real interest rates are kept high for a longer period of time, ultimately that's going to affect the credit cycle in South Africa, and it's going to actually be a headwind to domestic growth prospects, unless something else happens structurally or cyclically, which boosts growth and offsets the impact of that relatively high real interest rate.
Well, I want to dig into that debt market. I mean, you spoke about, bond yields coming down, and really just that bond market. What role does fixed income play in a local investment portfolio? And maybe just dig into, Merchant West Investments' fixed income philosophy and really what it brings to the landscape.
Yes, so I think, there's been a lot of value evident in the South African government bond market over the last 5 years. There's been a dislocation of our local government bond yields relative to other emerging market bonds, and certainly developed market bonds as well. And so we've taken advantage of that with relatively overweight positions across our various strategies to local government bonds. And I think to the extent that this lower inflation target has caused those bonds to outperform, to provide capital gains to us, we've been quite cautious to actually reduce our exposure over time, as the bonds have done relatively well. And that's because we're still, relatively cautious about the fiscal landscape, and the fact that, although a low inflation target perhaps supports the rand, it does nothing for government debt dynamics. In fact, to the extent that bond yields are lower due to a lower inflation target, your debt trajectory is still fairly steep, and the likelihood of a burst of inflation at some point, or some political volatility emanating from that fiscal situation is still reasonably high. And so we've taken the opportunity to switch out of the longer dated government bonds as they've rallied into less volatile instruments. Although I think in a diversified portfolio, South African government bonds still can be a really nice diversifier to offshore equity exposures. They're nicely negatively correlated to that, and I think there is still a place in a balanced fund for bonds, although we've reduced our the level of risk that we're willing to take as the bonds have done well in the last year or so.
I quickly want to drill into what you said as we wrap up the conversation, Daniel. You said that you're cautious about the fiscal landscape. And I mean, now we're looking to the medium-term budget policy statement that will be tabled on the 12th of November, if I'm correct. What do you think National Treasury then needs to achieve in order to stabilize the government budget?
Yeah. Well, the very simple answer to that is, given where interest rates are, they need to deliver primary budget surpluses, and larger primary budget surpluses than they currently are delivering. So, unfortunately, the only two ways to do that are through a program of relative austerity, so either raising taxes or cutting back expenditure. But of course, over the medium to longer term, the easier, or let's say the less socially difficult and politically difficult path would be to aggressively pursue growth boosting reforms. So there is some disagreement in the marketplace around what that actually looks like. In our opinion, ironically, something like tax cuts may be over the longer term, the catalyst for a higher growth trajectory, which ironically would stabilize the debt trajectory of the national government. But we're not sure that in the short term the market could tolerate that. Outside of that, it's the typical things, infrastructure programs being ramped up, especially regarding spatial infrastructure, transport infrastructure in particular, could have a very meaningful kind of expenditure multiplier in the economy. And that's the kind of thing that we would look to see a serious policy rethink, which allocates expenditure to those priorities much more aggressively, while maintaining, at least a primary budget surplus in the medium term is both necessary, unfortunately.
Okay, well, those will be factors and drivers that we will be looking out for. But thank you so much for that very insightful conversation, Daniel. That was MD of Merchant West Investments, Daniel King.